Today, we're doing something a little different. We aren't just looking at a bunch of red lines on a graph. Nope, we are stepping into the shoes of economic detectives, and we're going to perform a full-blown autopsy on history's absolute worst financial disasters. Think of this explainer as a meticulous, step-by-step investigation into the exact moments when the global financial heartbeat literally flatlined. We're going to explore the absolute darkest corners of market history to figure out precisely how unimaginable fortunes, wealth built up over decades, can just vanish right into thin air.
Zero. It's just a number, right? Well, in the world of high finance, zero is the ghost that haunts every single trading floor. When we talk about the world's most catastrophic collapses, we're not talking about a bad quarter or a missed earnings report or even just a temporary dip in your 401k. We are talking about absolute destruction. We're talking about once massive fortunes, global empires, and generations of compounded wealth falling all the way back to this single terrifying digit. The descent to zero is incredibly violent, and honestly, understanding the mechanics behind that freefall is pretty much the only way to avoid becoming collateral damage yourself.
So it begs the question, doesn't it? What turns a booming, seemingly invincible market into a catastrophic global disaster? Like, what is the hidden fatal flaw in our financial systems, and honestly, in human psychology, that guarantees these massive systemic crashes keep happening over and over again? Well, buckle up, because we are going to peel back the layers of market mechanics, human greed, and structural fragility to reveal exactly how the trap gets set.
Part 1. Anatomy of a Market Collapse. Uncovering the Life Cycle of Financial Disaster.
Okay, so first things first, a market collapse is, at its core, a systemic failure. It's that terrifying moment when the structural integrity of the entire financial ecosystem just gives way, resulting in the rapid, merciless evaporation of huge amounts of wealth. And to be clear, this isn't just about losing some on-paper profits. It is a moment of profound, sweeping contagion. We're talking about situations where liquidity dries up literally overnight, counterparty risk skyrockets, and credit markets just freeze entirely. The very foundation of trust that holds the whole financial system together, it shatters. Part 2. The illusion of endless wealth, the setup and human hubris. It's wild, but every single great crash in history is preceded by a terrifyingly consistent psychological evolution. It's like a script they all follow. It always begins with euphoria and hubris. Investors stop analyzing data and start believing they possess, some kind of magic touch. Valuations detach entirely from reality, and anyone who's skeptical gets mocked. The smart money might quietly start heading for the exits, but the noise of the boom just drowns them out. Then we hit step 2, blind, widespread investment. The contagion of greed spreads from institutional trading desks right down to the everyday public. Retail money pours blindly into assets they don't fully understand simply because, hey, the price is going up. Fear of missing out, good old FOMO, becomes the entire investment thesis. And finally, the trap is fully set with peak systemic vulnerability. The market becomes completely over-leveraged. It turns into a giant house of cards built on margin debt and derivatives, reaching for the stratosphere, completely blind to the ticking time bomb buried in its own foundation.
Part 3. The inevitable tipping point. When reality catches up.
And here we find the fatal disconnect. On one side of the scale, you have market expectations. Basically, a blind arrogance built on the promise of infinite growth, sustained by cheap credit and totally unchecked speculation. But pushing relentlessly against it on the other side is economic reality. We're talking unsustainable valuations, toxic assets, and deep hidden flaws within the financial plumbing itself. For a while, the illusion holds together. But a crash? A crash is simply the violent, instantaneous moment when the market is forced to reconcile these two opposing forces. The rubber band of reality snaps back, and the resulting shockwave triggers a brutal cascade of liquidations that breaks the entire system.
Part 4. Panic hits the trading floor. The free fall begins. Now, the absolute most terrifying element of a crash isn't how far things drop, it's the speed. We aren't talking about a slow, gentle decline over years or even months. No, within hours of hitting that tipping point, the frantic race to the exits begins. Margin calls force involuntary liquidations, algorithmic trading completely accelerates the downward spiral, and liquidity just evaporates. Within days, that initial heavy selling morphs into pure, widespread panic. Logic entirely disappears. It becomes this desperate, primal attempt to salvage pennies on the dollar. And within weeks, total systemic collapse takes hold. The gears of the global economy just freeze up. the speed of the destruction is absolute, leaving institutions and retail investors alike completely paralyzed, with zero time to react before the floor falls out completely. Part 5. The devastating global aftermath, the true cost of the crash.
When the dust finally settles, the mathematical reality of a collapse is just staggering. Up to 90% of a market's perceived wealth can be classified as evaporated. And I use that word deliberately. The wealth didn't merely change hands, it literally ceased to exist. Because, you see, it was phantom wealth to begin with. It was a mirage sustained only by collective belief and excessive leverage, and it gets completely wiped out in a matter of weeks. That tiny sliver of a fraction remaining, that is the only actual tangible value left standing in the rubble. It's an incredibly brutal wealth transfer mechanism that completely unrecognizably resets the economic landscape. But honestly, behind all the evaporated wealth, behind the timelines, and behind that terrifying zero are real human tragedies. These collapses are not just anomalies in a spreadsheet. They are towering monuments to collective hubris. They represent decades of innovation shuttered overnight, massive institutional legacies erased, life savings vaporized, and entire generations forced to rebuild from scratch. It is a strictly human phenomenon, born out of our own psychological flaws, just playing out on a massive macroeconomic scale.
So let's bring it all together. If you take anything away from this autopsy today, I want you to remember these 4 pillars. First, the illusion of hubris always sets the stage, masking deep systemic risk with the euphoric promise of easy money. Second, the fatal disconnect between those sky-high expectations and grounded economic reality is what eventually pulls the trigger. Third, the speed of panic dictates the severity, moving way faster than any fancy risk model can actually predict. And finally, the human cost is the lingering, devastating aftermath left behind in the rubble. Understanding this anatomy is absolutely key to seeing through the fog of the next great boom. We've thoroughly dissected the past. We've seen exactly how euphoria turns straight to zero. So, take a look around at the markets today. I want you to ask yourself, is the illusion of endless wealth quietly building the next great crash right now? Because the anatomy of a disaster doesn't ever really change. Only the year does.